Good afternoon, ladies and gentlemen. Welcome to the Barometer Readings monthly conference call. At this time, all participants are in a listen-only mode. Following the presentation, we will conduct a question-and-answer session, at which time instructions will be provided. For operator assistance during the call, please press star 0. I would now like to turn the meeting over to Sarah Petoskey. Please go ahead, Ms. Petoskey.
On the Barometer Readings monthly conference call. My name is Sarah Petoskey, Regional Vice President of Sales at Barometer. First of all, I'd like to thank all of you for your continued support this year. Since this is the last call of 2014, we'll take the time to review the year. We'll discuss major shifts in the portfolios and how we are positioned as we head into the new year. Joining us on the call is David Burrows, President and Chief Investment Strategist. At the end of the call, there will be an opportunity to address any questions you may have. With that, I will pass it over to Dave.
Hey, folks. Dave here. Thanks very much for taking the time. We're getting late in the year, and I know people have lots of things to do, but we thought it might make some sense just to have a quick review as to what's going on out there and what we've been doing in the portfolios. You know, it's interesting. We spend a lot of time talking about the fact that over periods of time, conditions change, and what's working changes. Leadership comes and leadership goes in the market. And really, we see it as our job to track where money is moving and try to target areas of market leadership in the portfolios. Because realistically, the clients all expect us to find them good ideas, but they expect us to build portfolios that are relevant in the current climate. And, you know, if you went back to the period leading up to the financial crisis, interestingly, in 2007, a year before the crisis, there began a long process of deterioration in financial services companies. As measured by the tools that we use of breadth models, we started seeing deterioration in the fall of 2007. And slowly, over a period of time, we were taken out of our financials positions, both through them hitting stops and through rotating away to other sectors, so that ultimately, when we wound up in the early stages of the crisis, we had very little financial services. It doesn't mean we didn't give some up off the top. We certainly did. But in rotating, the portfolio moved. When we got to the early part of 2008, June, when things started to get worse, the breadth models that we use for the equity asset class started to show some deterioration at the same time as we saw some weakness in energy. And this was our big weight in the portfolios at that time. And it wasn't over a week or two, but it was over the course of about 2.5 months. First of all, energy came out, I guess over the course of about a month or 6 weeks. And the cash positions rose steadily through the summer until by the time we got to September of that year, we had, close to 75% of our portfolio sitting in cash. Now, the way a correction starts always is with a few positions selling off, generally the weaker ones in a universe, and that slowly will hit more and more securities. And along the way, it's the job of a manager and an investor to start moving away. The thing you have to make sure you have done is that you've gotten out of the way of the trouble by the time the wheels come off. And, of course, that fall from September to November, the S&P went down 38%. And, you know, we certainly were impacted in some ways, but in a very, very moderated way, and came out of that debacle, fairly well intact. When we came through the early part of 2009, we built positions in things like bank bonds and real estate investment trusts and preferred shares. And those were the money makers for the next 2 years. Things that were more or less interest rate proxies, low economic sensitivity, very high predictability, very steady dividend yields. And they were great until they weren't. In 2012, if you remember in the spring, we started to see a rise in rates, and breadth models for things like REITs and telcos and utilities started selling off. And with that, we had a dip in our portfolio as we got stopped out of positions, and ultimately over the course of 6 or 8 weeks repositioned to dividend growth, things that were a little more economically sensitive, things with lower dividend payouts but faster dividend growth, things that did better in a stronger economy, and the portfolio moved, and that set us up for the next 2 years. So from time to time, these things happen. Every time it happens, we get calls and questions as to what stops are working because the portfolios dip a few percent. But the goal ultimately is always to reposition for what's coming next. And invariably there will be people that ask, well, should we be buying this dip, and are they going to come back? And ultimately, generally, the best answer is to say, where's the money going next, and reposition. So that leads us to October, November of this year, and probably a little bit earlier. You know that our belief has been that we are in a new secular bull market for equities, and that a world of low inflation benefits developed consumer-led economies. And we have seen relative underperformance in commodities for about 18 months. And it was across a broad range of commodities. They weren't necessarily dropping a ton, they just were underperforming. Emerging markets also that had been leading in the period between 2000 and 2012 underperformed. But when we looked at the breadth models as we went through this summer, the strength in energy producers based on the boom in production started to wane, and we saw breadth models start to deteriorate. Our big weights in the portfolio in the summer of this year were energy producers and energy infrastructure across most of our portfolios. In the equity portfolios, close to 40%. Over the course of about 8 weeks, the energy producers weighting came out of the portfolios, as slowly there was a pickup in the decline in energy. Now, within the energy spectrum, the least correlated to the price of oil would be the infrastructure companies, the pipelines, the processors, and the storage companies. But while you can make a fundamental case why it is that distributions will continue to be good, and why it is that there shouldn't be concern about fundamentals because there are long-term take-or-pay contracts, by the nature of the fact that they are part of the energy sector, sooner or later, if things get bad enough, they will be impacted too. And, of course, that's what happened into November of this year. So it's interesting. We've seen, obviously, over the last few weeks, an acceleration in the decline of the price of oil. Earlier this week we hit $53 or $54 a barrel. Virtually everything was for sale. And as it happens in a correction, people get nervous when things move quickly. It starts to impact other sectors other than the key one going through the decline. So you started to see some weakness over the last few weeks in Canadian financials. And people start to look for knock-on effects. When you have something move very quickly, people start to ask the question, what else are we missing? Are there other risks that maybe might appear? And I think it's safe to say that over the last couple of weeks, there's been a lot of people asking the question, what does this decline mean? Are we headed into a real slowdown globally? Are we headed into deflation? Is it more than just simply a supply-demand imbalance? So when we look at our work, there's a lot of things that we can try and suss out in looking at all these moving parts. But ultimately, we find that the breadth models are our guide. The fact is, through the fall, breadth in energy sector deteriorated. It took us piece by piece out of our positions. We'd love to say we get out of the positions at the top. It never happens. The energy infrastructure stocks were our bread and butter for over 4 years. They made us tremendous returns, and if we'd sold them every time somebody told us that they were expensive, we would have been gone long ago. Ultimately, though, the energy positions came out, energy infrastructure in the portfolio got cut by 2/3, and we wind up with a single-digit exposure to that space. On the other side, however, breadth for the U.S. equity market has very steadily expanded over the course of this year, with a small interruption in the month of October. As it sits today, equity breadth in the NYSE is positive. Equity breadth in the S&P 500 is positive. Equity breadth in the NASDAQ is positive. There has been virtually no deterioration in those universes. When we look at the sector levels, we've spent most of this year talking about the fact that leadership has been very clear. It's been in consumer, it's been in financials, it's been in healthcare, it's been in technology, and it's been in transports. So when you look at where we are today, month to date, Consumer discretionary home entertainment up 7.5%. Drug retail up 5.9% for the month. Healthcare facilities management or hospitals up 5.5%. Specialty retail up 5.5%. Auto retail up 5.5%. In the financials, investment banks and brokerage up 4.7%. Technology, electronic equipment up 4.25%. In healthcare, biotech up 4.25%. This is with the volatility that we've seen. On the other side, you've got diversified metals and mining in the S&P down 15% month to date. Coal and alternative fuel down 9.5%. Aluminum producers down 8.7%. Steel index down 7.5%. You get the gist of this. We are in a have and have not market. And the way we see it is that as long as breadth is expanding, so long as breadth in the key sectors of leadership that we've seen all through the year are expanding, it's okay to see pullbacks. That happens, but when the buyers come back, they come back with a vengeance. Now, we've just seen the biggest two-day rally since 2011. And if we were trying to protect against any kind of decline and going to the sidelines every time stocks pulled back, we would have been sitting this rally out. Most of our portfolios were up today 2 to 2.5% across equity and income portfolios. Very, very good day. I think we are positioned in the right spots. So ultimately our job is to position for what's coming next. Now, the rise in volumes of production and energy in the U.S. has been a substantial tailwind to the U.S. economy. It had been a tailwind to producers until ultimately it looks as though we've hit a tipping point where there is some excess supply in the system and pricing power for oil has gone away for now. It doesn't mean that volume is gone, and we would make the case that fundamentally we should have some exposure to energy infrastructure. We have some that have pulled back but have not broken badly. But on the other side, there's an even bigger tailwind for the consumer sector and for the domestic economy. We've seen very, very strong improvement across those spaces. So we would make the case that we're set up for next year. We have a great chart that plots the Bloomberg Index of Economic Surprise, which rises when economic indicators are surprising to the upside, and how it is correlated to the price of oil. If you invert the price of oil, in other words, the chart moves higher when the price of oil is moving lower, you can see an extremely tight correlation to economic surprise against the price of oil, except for the fact that there's about a 6-month lag. So given the fact that we've just had a parabolic decline in the price of oil, you should expect over the next 3 to 4 months to see substantial upside surprise in economic data. And I think that the market is reflecting that. Yes, there's concern about emerging markets and their ability to pay debt. A strong U.S. dollar makes it tough for bond issuers to pay debt back that's in U.S. dollars. Yes, the low commodity prices give them less revenue to be able to pay that debt. We have virtually no exposure to emerging markets. We have virtually no exposure to high-yield emerging market debt. Both of those we would stay away from. In the high-yield market in the U.S., high-yield bonds have been selling off, largely led by issuers from the energy industry. We have virtually no exposure to high yield. In the fixed income markets, we don't think there is a strong enough risk premium being offered in investment-grade bonds to make a big addition there. And sovereign debt, we know that interest rates are at 100-year lows around the world. Not to say that they're headed higher, but we think that there's not much opportunity to make money there. So across our portfolios, as we sit today, we are largely fully invested. Our focus has been to consistently increase our exposure to the U.S. stock market. The income portfolio today is about 53% U.S., and that, as you know, has steadily been rising. Our equity portfolios, close to 70% U.S. ETF portfolio, 100% U.S. Long short, about 55% U.S. Very strong U.S. exposure. The income portfolio is focused on dividend growth, companies that are somewhat economically sensitive, where the payouts are low but are rising. It looks as though we'll finish the year with approximately 20% dividend growth in the portfolio. We went through some of the portfolios today. In some cases, there wasn't one down position in the portfolio. So everything is participating. So the question I think a lot of people have is, should we expect a big bounce in the things that have sold off recently? Certainly there could be a bounce. That's not where we'd be putting our money. When leadership changes, it tends to change for a while. And I think that any bounce in energy in the near term, or any bounce in metals, or any bounce in golds, probably represents more of a trade than a new secular theme. So you shouldn't expect to see us jumping on the bandwagon there. I think that while golds and metals and energy have had a big sell-off, and there certainly has been tax loss selling, they could have a bounce as the tax loss selling is reduced. We would see those as more as lightening up opportunities. But I think that we are positioned extremely well. So just to run through the weightings, the high-income pool and funds sit at about 37% financials. And when I say financials, it's a combination of Wall Street firms like Morgan Stanley and asset managers, banks, primarily now U.S. banks, things like Bank of America, Citigroup, Wells Fargo, J.P. Morgan, with a smaller Canadian content, Royal, BMO, and TD. We have insurance, largely property and casualty insurance. I think we have 5 different names in the portfolio. Financial technology, and one of the exchanges, the ICE exchange. So that is a diverse sector. It is benefiting in the current environment. We do think that dividends have been held back as we've been going along here by the Fed. Behind financials, we have a much smaller energy weight, single digit in infrastructure, and some refining. Refiners benefit from weakening energy prices. Transportation makes up about 12% of the portfolio. Consumer makes up 10%, and consumer is spread across leisure, media, airlines, retailers, and consumer staples. Healthcare, which includes biotech, pharma, and hospital management, and some consumer staples. So we are focused in these leading sectors. In the equity portfolio, very similar, larger in technology weighting, about 27% of the portfolio. Consumer makes up 16%. That's in staples. Consumer discretionary, 14%. So close to 30% consumer. Healthcare makes up 13%. Financials make up 12%. We don't expect to see significant shifts in the portfolio to finish out the year. One thing that we have been doing is increasing our weight in mid-cap stocks and a few smaller cap stocks to get ready for potential year-end rally in small caps. Often January, February, you see net buying in these spaces. They've underperformed all year long. They have been relative outperformers over the last 7 trading days. So there does appear to be some rotation there. So as we close out the year, unless something dramatic happens, this will be the 3rd year of multiple expansion in the U.S. stock market. After no years of multiple expansion between the year 2000 and 2012. This is what makes a secular bull market: earnings growth and multiple expansion. We think that next year sets up to be particularly strong given the tailwind we'll have in the U.S. due to weak energy prices and very low inflation. We think that the language in the Fed's comments this week pointed to the fact that we shouldn't expect to see interest rates change dramatically in the near term. And when we look at fixed income markets, credit default swaps on financials continue to point to a normal operating environment. So there's always things to worry about. There's always conjecture in the media about what might or may not be happening. Ultimately, we like to follow our breadth models, follow our process, and take things step by step. But I think that we're set up to come out of this year and ready for the next 18 months in a pretty good spot. With that, maybe I can pass it back to Sarah.
So before we take any questions, I just want to thank you again for your support this year. If you have any questions after the call, please do not hesitate to contact Nick Hamilton Kayla Peacock, or myself. We look forward to working with you in the new year, and our next call will take place on Tuesday, January 20th at 4:15 Eastern Time. Best wishes for a wonderful holiday season and all the best in 2015.